The following is paid programming. Welcome to Something More with Chris Boyd, certified financial planner practitioner and founder of Asset Management Resources, LLC, a registered investment advisor firm. We call it Something More because we like to talk not only about those important dollar and cents issues, but also the quality of life issues that make the money matters matter. Here he is, your fulfillment facilitator, your partner in prosperity, advising clients across the country, your host, J. Christopher Boyd.
Welcome to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner. I'm here with Jeff Perry, JD, who is also with the our firm, Asset Management Resources, and lots happening in the world today in the world of finance this week. So we're going to jump right in and talk about a variety of the financial news issues that are moving markets and try to help make a little sense of what to make of this. How does this influence investors, and what are some of the things that you might want to be thinking about? And as we kind of move toward year end, it's a time to be thinking about your portfolio a little bit. And just as an aside, Jeff, it's the time of year when things have maybe moved from the way you started the year. And
it's maybe moved.
And it's maybe a good time to be looking at rebalancing and some of the changes you might have, or whether or not you've got the right mix of investments. And just as an aside, this time of year, as we get to year end or the beginning of a new year, that's when most people get kind of serious about their investments for a review, because we're all ready for new habits and
very habits. Time of year to reflect on the past year and think about next year goals or ambitions or
And we'll be talking about that in depth over the next couple of weeks. But just while I'm mentioning it, we often at this time of year offer a complimentary portfolio review offering, which we will be doing in earnest at the turn of the year and into January. But if you would like to get a jump on that, you're more than welcome to reach out to us. You can connect to us through our website, amrfinancial.com, or you can reach out and give us a call, 508-771-8900. But if you send us a correspondence or through the website or whatever, you can just mention the portfolio offer that you'd like to be included when we do begin that offering of a portfolio review. We only offer usually about 10 of these. And so that's what we plan to do is, usually we like for people to have some assets of $500,000 or more, but that's not rigid. So if you have some need for help in this regard, we're happy to help. So in any case, as we think about this, let's dive into all that's going on, because it can be the time of year when you really should think about how should this affect my investments. So Jeff, where should we begin with all the data that's been coming at us and all the news of the week?
There's a lot here, Chris. I don't know if it's certainly not December 25th. But Santa Claus has arrived in the form of a rally, and it's directly related to the data, directly related to the Fed, right? The Fed was very, he surprised a lot of people this week with his comments.
So it definitely was a surprise, right? We didn't expect to have this kind of forecast that he provided. I won't spoil it, so you tell them.
Well, for the people who watch the Fed, they know that they have been increasing the short-term interest rates over and over again, to the point of 5.25 to 5.5 was the range that they've tried to keep the short-term rate at. And the goal of increasing interest rates by the Fed is to slow the economy down, all because of the inflation that we all remember. It's that we've been suffering with last 18 months or so. And so to slow the economy down, one of the major tools from the Federal Reserve is to increase interest rates. And along with that, not every month, but almost every month when the Fed has a meeting, the chairman comes out and gives his comments, and those comments are either hawkish or dovish, meaning hawkish, which they have been, meaning to keep people guessing, I guess. Or I guess a couple of months ago it was longer rates, higher rates for longer.
Higher
right?
for longer. That was the mantra, right?
And so, in my view, I'd love your view, those comments, more than the rates themselves, but those comments of having a sense that we're going to have higher interest rates for longer have put a lid on the market's activity.
Yeah, I definitely think that the rhetoric that the Fed uses is almost as important as the actual policy itself, right? It's trying to move markets by what they say and how they forecast what they say, and that's what made this announcement somewhat unusual a little bit, where we were expecting that same rhetoric of higher for longer.
Yep.
And that changed.
It's not what we got. We got the data, which we'll go over in a few minutes, is very positive. That inflation is more towards their target. But Chairman Powell, in his 2 p.m. press conference on Wednesday, I guess it was, said, "Yeah, we could probably expect 3 interest rate cuts in 2024."
Yeah, wow.
And the market, once everybody, did I hear that wrong? Is he raising rates?
Raising or cutting? Yeah.
People were getting it wrong because we're just so accustomed to him saying rates could go higher,
Yeah. Well, I think as you look at this, let's talk about the inflation for a second, because that's the one that's so interesting and on everyone's mind. We as consumers, we think about inflation and say, when's it going to go down? The prices have gone up. When are they going to go down? And that's not really what we're expecting when we talk about lower inflation. We're just talking about a lower rate of increase of prices. And frankly, we don't really want. I'm sure there are places where we want prices to go down. Go to the grocery store and we're all feeling it. But
some things that went too high.
Yeah,
but not down.
Well, gas prices have seen some of that, right? They'd gone up and they've come back a little bit. But I don't think we're going to see that really when it comes to broadly when it comes to groceries and so forth. And we don't necessarily want deflation. It's a bad thing for the economy. It can be a vicious spiraling cycle that can really send an economy circling in the wrong direction, down the toilet bowl or something, So we don't want that. So what we do necessarily want is slower inflation, and we've been coming down. Where we had double-digit inflation at one point. As you look at where we are most recently in the threes. Was it 3.2, 3. Where we
3.1? Yeah, the latest CPI, which is the Consumer Price Index, was up 0.1% for November, and annualized rate now at 3.1%. Now the Fed's goal is 2%.
Right.
That's their stated goal.
And core was a little higher, as I recall, too.
That's right.
That wasn't as appealing. But so if 2% is your goal and 3% ish is where we're at, it seems like we're getting pretty close. I will say that it does seem like historically 3% was a more normal. Before the 2000s, this millennia, we used to talk about 3.5% as the long-term rate of inflation as normal. But now we've been in this 2% range or lower really for a really long time. So that's kind of what we now envision and aspire to, and that sounds good. But even if it stays, somewhere between 2 and 3%, that doesn't seem like that's long-term problematic for an economy or anything like that. So, but
there's a lot of people who are suggesting that the Fed isn't really at 2%. That it's a stated goal, just like higher for longer was a stated goal.
Yeah, and what it really ends up being. Yeah.
But you were talking about things that are going up and down in that CPI report.
Yeah.
It details, if you dig into it, and there's plenty of info online, but like eggs were down 22%. And so eggs aren't down 22% from 2019. They're down from a year ago, right? Because we all saw the eggs and butter and a lot of food items just went through the roof. So food items were generally down from a year ago. Fuel oil and gasoline are down. You mentioned those two.
Yeah.
Those are important things.
And these are ways we feel it, right?
Right.
Groceries and energy costs, of course, those are the part they take out because they tend to be more volatile when they talk about core inflation. But
right.
You mentioned 2019, and I think we might have mentioned this on a previous episode, but I had seen something, I think it was a podcast I listened to, that they had said that since 2019, prices are up about 20%, and that's why people feel so.
Yes, I listened to the same one. It was a New York Times podcast that you would send me.
Right? Yeah. So that's really interesting, I think, because when okay, it was big, it's lower today, but when you start saying in a relatively short period of time, 4 years time, you're having a 20% increase in your expenses, and most people don't have a 20% increase in pay in that same period of time.
It happens so quickly. That's the psychology of it. Like,
yeah,
over
you feel
4
it.
years, it happened in a real short time period due to supply chains and the infusion of government cash and all the things that we
all that stuff. Yeah,
right. So it's I think the psychology of it is real. And people want it to go back to that level, and they think that would be normal. Normal would be to have over 4 years, maybe 8 to 12% inflation.
Yeah,
not 20, right? So
right. So you feel that difference, and you walk out of the grocery store and say, "How much? What did I get? How did that happen?"
It's real, and groceries and gasoline, fuel oil do hit the people with the lowest income the hardest.
Yeah, you do really notice that you can imagine a young family with maybe not their peak income potential yet achieved, right? And feeding a family is expensive, and driving them all around, and all that kind of stuff, and commuting and so forth. You can see how it would really feel that pinch. And of course, you talked about this when the student loans started kicking back in, and all these kind of things that kind of factor into really feel like there's a pinch.
Yeah, when you have less margin in your budget, it matters if your groceries are $40 more a week and your gas is $20 more a week.
Yeah, and now if you're trying to buy a house, costs have gone up, and inflation, the rate and the interest rates on the mortgages are higher, significantly higher. All these kind of things, start to accumulate, and it just feels painful, So I think that's true for people who are at one end of the income spectrum. They feel it much more acutely.
They do. Some other things that were down in this inflation report were airline fares, appliances, computers, games, things like that.
Yeah. So
maybe just in time for Christmas.
I was just going to make that same comment. Yeah, good planning for this time of year. A little travel, or maybe a new computer or something. Sounds good.
So, back to the numbers, some other numbers for a minute. And I think listen to these numbers. It's not just the CPI, which is the big headline one that's been in the news. People understand that.
CPI, Consumer Price Index. It's the inflation gauge that most people look to when they think about cost of goods and services rising. It's the one that Social Security tends to look to, although they may not look at it the exact CPI. They have some variation of the CPI, but that's not the Fed's chosen metric, huh?
Well, they certainly look at it, but they also look at things like the Producer Price Index, which is what the producers, the people who make things, right? What they're doing with their pricing. And for October, it was down 0.4%, and in November it was unchanged. So that's 6 months of either no change or declines. So I mean, the theory, which makes sense, is that if producers' costs are less to produce things,
Yeah.
At the beginning of the supply chain, I guess.
Yeah.
Once they get
Would you
into
expect that to work its way into prices ultimately?
That's right. So that's a positive sign. And then the PCE, which is the core personal consumption expenditure, right?
So that's the Fed's preferred inflation gauge, but this is the core you're referring to?
This is the core. So we're taking out those things like groceries and fuel, and which is, you're right. You said it perfectly. This figure, PCE core, is what the Fed relies on the most, allegedly. And we don't really know what they rely on. But so that annualized rate is 2.4%. Based on the last.
That's very interesting.
That's pretty good.
In the twos, yeah.
So I think these three numbers, jobless claims are, sticking around. The continuing claims, 1.8 million. This past week, it was 202,000, and that's a little less than anticipated. Retail sales were up 0.3%, showing the consumer is still strong, right? So I think when you take all of these numbers from the week, if the Federal Reserve, Chairman Powell, looking at it, they're saying it's pretty good out there. Maybe we're a little too high, and maybe we should go back next year. And so that's what he said. I'm with you in your opening comments that I'm not surprised that we're heading that way with these numbers.
Yeah.
It's almost like the Fed's taking a victory lap here, which maybe they're entitled, they're entitled to do, right? I mean,
yeah. I mean, why not, right?
Right.
They got so much grief with the what was the early stages of the Fed with the inflation concerns.
Transitory.
Yeah, they took a lot of heat for that.
Well, that was more the Treasury Secretary, I think. But I mean, they all get lumped into one anyway.
Yeah.
In the eyes of the citizens here, but so maybe they're taking a victory lap. Maybe they're just responding to the data. Whatever it is, I didn't expect him in his press conference to say that rate cuts. And so what would we see at the end of the week? We saw bond prices declining quite a bit. The 10-year was under 4%. We haven't seen that in a while.
What a move we've had in the 10-year Treasury when you think about it. I mean, it was maybe in October, we're at 5% on the 10-year.
Right. So
and now we've fallen below 4. What does that mean for investors, though, Jeff? When you think about
it depends what you're thinking about for investor. If you're one of those people who have owned bonds or have been buying bonds, bond funds or bonds, with the expectation that rates would hopefully go down someday, you're getting capital appreciation in your bonds. So when the yields go down, which they're heading down, the value of the bonds that you hold
go
up, right? It's a kind of an inverse, kind of a backwards way to look at it, but
so that kind of a situation is probably somewhat advantageous for existing bondholders to receive some appreciation, though presumably that will also mean that income will go down over time, right? Because bonds mature and get reinvested, or at least that's what the bond market seems to be interpreting. That will mean that based on the movement of the Treasury, 10-year Treasury that way, and then that also implies perhaps that just as an aside for people looking for mortgages. That implies that mortgage rates are likely to become lower. They seem to move
and they did this
similar to treasuries. 10-year Treasury is kind of a worthwhile bond measure to look at as to directionally what's going to happen with mortgages. And then it's also probably a favorable implication for stock owners. Why? Because if it costs less to borrow money to start a business, to invest in research and development, or fill in the blanks, right? It's that much more viable to invest and grow and get enhanced profitability.
Absolutely, and for an investor, if you're an investor and you're saying, all right, I can get 5.5% in a bond or a mutual fund, I mean, a money market fund, without taking any risk, I'm going to maybe logically put some money into a money market fund and let it sit there. So a couple comments on that. Those opportunities are probably going to be decreasing. There's going to be less chance you're going to get those very attractive rates with bond yields going down. And also, I think it's an important time to say something that we say all the time about people who are day trading or trying to trade in and out of the market. If last week you said, I'm going to, grab some yield in a money market account and wait for an all clear for the market, right?
Yeah.
Which, it never exists. But people, when the market's more settled, I'm going to get back in. The actions of the past week just indicate very clearly that it's time in the market, not timing the market. Because if you did that, you missed everything that happened recently. And
since
it's been
October,
quite a ride up. Now, I'm not
yeah.
saying you're not going to have a correction here. Nobody knows is the thing, right?
Yeah. This is an interesting thing to, you and I were talking about this yesterday, just
Right.
Off to the side. And, I think when you look at valuations, they're not inexpensive, but
Right.
maybe that, when you look at valuations, I know it's imperfect, but we often look at the forward-looking price to earnings ratio, and that as a shorthand for valuation, right, for the market. And of course, I mean, earnings could improve if we've got this setting where things are getting easier, if you will, and that could be favorable for the valuations to just be justified, right?
Well, history tells us that. It doesn't mean it's going to repeat, but the old saying, "Don't fight the Fed," right?
Yeah, that kind of mindset, right? So, I think on the one hand, we want to be mindful that we want to buy things when they're reasonably priced. At the same time, you've got this changing dynamic that could be favorable for earnings, and therefore imply that prices could go higher, which might not make it feel as priced. It's I don't even want to say overpriced, but you know what I'm saying.
Right.
It's not cheap. So in any case, I had something else I was going to mention, but we'll come back to it if I think of it. Go ahead.
So my point is that if you try to time these things either way, get out before they go down or get in before they go back up, you often miss opportunities because a lot of the gains in the markets or the declines, but this week we're talking about gains, happen all at once. They happen very suddenly. And
they can be explosive of sorts, and I think that that points to trying to also pay attention to where in the market you want to be right now, because there could be opportunities along the way. Your point about cash, though, I think is also an interesting one, because at 5% range for money market mutual funds, and we've had some CDs in that range. Well, clearly that's likely to change direction if based on what the Fed is indicating, and so you may enjoy that cash, but it may not be as attractive as long, as you might entertain.
Yeah.
So, I guess the outcome is step back, take a moment, give some thought to what are the possibilities, what's the right positioning to be in, whether it's in your stocks or in your bonds or however your portfolio is structured. Now's a good time to, as we head toward a year end and a transition of things. I think, Jeff, one of the things we'll want to talk about in another segment, because we're running out of time here, but I think inevitably the thing people have on their mind now is, well, how will next year's political environment influence my portfolio? People often think about that in election years, and I think that's something we'll certainly want to talk more about.
Interesting subject. I look forward to that. We should bring our Chief Investment Officer Brian Regan in on that one. He always has a lot to say on that subject.
All right. Well, with that, we're going to take a break. Until next time, keep striving for something more.
Thank you for listening to Something More with Chris Boyd. Call us for help, whether it's financial planning, portfolio management, insurance concerns, or those quality of life issues that make the money matters matter. Whatever's on your mind, visit us at amrfinancial.com or call us toll free at 866-771-8901 or send us your questions to radio@amrfinancial.com.